In this video, I'm going to share with you everything that you need to know about pensions. So why not pour yourself a cup of coffee, sit back, relax, and enjoy everything you need to know about pensions. This video is split into two parts, as you might imagine. The first part is getting your money in a pension, and that has 4 sections: the annual allowance, tax relief, death benefits, and the state pension. The second part is all about getting your money back out again, and that is split into 7 parts: pension commencement lump sum, also known as tax-free cash, benefit options, the lifetime allowance, taxation, the money purchase annual allowance, death benefits, and state pensions. So sit back, relax, and enjoy the unified theory of pensions. For clarification, this video is only aimed at money purchase arrangements, also known as defined contribution schemes. If you're not sure, you need to seek professional advice from a regulated financial advisor before making any changes to your pension landscape. Now, regulatory warning, nothing in this video is advice, and you should seek professional help from a regulated financial advisor before making any changes to your pension landscape. Now, don't forget to like this video, subscribe to the channel, and ring that notification bell so you don't miss out on our next video. Now, retirement is becoming a bit of an outdated concept. Rarely do people stop work on a Friday and spend the rest of their life in the garden, on the golf course, knitting, etc. Instead, they may reduce their hours, find a new part-time job, or volunteer in the community. Many people enjoy aspects of their working life and want them to continue. There may be mental and physical well-being benefits from continuing to engage in some gainful employment, not to mention the social dimension associated with work. So we like to reframe retirement as financial independence. Financial independence is that magical moment when you no longer have to work to generate the income you need for your desired lifestyle. Let me just say that again. It's a really powerful sentence. Financial independence, i.e. retirement, is that magical moment when you no longer have to work for the income to support your ideal lifestyle. You might choose to work, but it's a choice, not a necessity. You may have come across the FIRE movement, Financial Independence Retire Early. Well, this is exactly the same idea, except there's usually not enough money or time to retire early in the FIRE sense, but retire early for some people might mean not having to wait until state pension age to reduce time spent working. A pension is simply one of the places you can accumulate money for retirement before you start taking money back out again to fund your retirement lifestyle. Pensions are a tax efficient way of saving for your retirement, and tax efficient is a fancy way of saying you get free money from the government and possibly pay less tax if you pay into a pension. The funds are invested and there's no capital gains tax or inheritance tax on the funds within the scheme. Now, saving for retirement has been made easier with the introduction of the workplace auto-enrolment schemes, but this might not be applicable to everyone. Now, the amount you can put into your pension without having to pay the annual allowance tax charge depends on your individual circumstances. The annual allowance for the 2022-23 tax year is the lower of £40,000 or up to your annual salary before any tax is paid. The annual allowance is tapered if threshold income is over £200,000 or net adjusted income is over £240,000. This essentially reduces the amount that can be paid into a pension for high earners. Non-taxpayers or taxpayers with no earned income, then the annual allowance is £3,600 per annum. If you haven't used your pension allowance within the last 3 years and have relevant UK earnings, then you might be able to utilise the carry forward facility, which means you could put in more than the current annual allowance of £40,000. Now, this only applies if you have earnings above this level to support it. Now, there's also a limit on how much you can accrue in your pensions within your lifetime before any tax is paid. This is known as the lifetime allowance and is currently £1,073,100 for the 2022-23 tax year. This is fixed to 2026. But this isn't really relevant if you're in the accumulation phase of saving for your retirement. So not only are pensions tax efficient, there's no CGT or inheritance tax, but you also have the option of getting more money paid into your pension by the government. This is known as tax relief. Tax relief is available for member contributions up to 100% of annual earnings and before age 75. The contribution is made net of basic rate tax and the tax relief is automatically added in. A higher rate taxpayer can claim an extra 20% via self-assessment or amended tax code up to the amount of income that 40% tax has been paid. Similarly, for an additional rate taxpayer, an extra 25% can be claimed using the same method. Within your pensions, you're able to set up death benefit nominations, which eases administration on your death. It means that the scheme provider can pass your pension benefits to anyone that you choose. If you haven't already done so, make sure you contact your pension provider and set up your nominations. It's equally as important to make sure that these are up to date and that it reflects your current wishes. Now, to access your pension funds, you must be aged 55 or over. However, in 2028, this is due to increase to 57 for those people born after the 5th of April 1973. Now, when accessing pension funds, 25% of this is tax-free and known as a pension commencement lump sum, but still largely referred to as tax-free cash. This must be taken before age 75. With the remaining 75%, you can have it all as a lump sum, minus any income tax, purchase an annuity and receive a guaranteed income for the rest of your life, or place the funds into Flexi Access Drawdown. Now, with Flexi Access Drawdown, the funds can remain invested and you can elect to either take out funds on an ad hoc basis or set up regular income withdrawals. All pension benefits taken are taxed at the recipient's highest marginal rate of income tax that is over their personal allowance. So there's also a money purchase annual allowance. So please bear in mind that once you access your pension, you will be subject to what's called the money purchase annual allowance. This reduces the amount you can put into your pension down to £4,000 per annum. Now, the money purchase annual allowance only applies when withdrawing pension income and does not apply if only tax-free cash is withdrawn. When it comes to death benefits, the first key point to remember here is that if you die before the age of 75, then all pension benefits are passed to your nominated beneficiaries free of income tax and outside your estate for inheritance tax. Whereas if you die after age 75, then all pension benefits are passed to your nominated beneficiary, again outside your estate for inheritance tax, but taxable at the highest marginal rate of income tax in the year of withdrawal. Depending on the pension provider, generally the options for taking benefits are as follows. Lump sum, take all the benefits in one go as taxable income. Dependents Flexi Access Drawdown and continue to build up a retirement pot in a tax efficient environment. Purchase an annuity for guaranteed income at retirement. Pension benefits are held outside of an estate for inheritance tax purposes as long as these are distributed within 2 years from the date of death. Now, alongside any personal pensions you may have, you will also have your state pension. Firstly, it's important to remember that your state pension is different to other forms of retirement provision. The state pension is provided to you by the government, and the amount you receive is based on your national insurance contributions. In order to get the full state pension, you will need to have 35 qualifying years of national insurance contributions. Otherwise, you'll receive a reduced state pension. There is the option to make voluntary contributions for the years that you did not make full national insurance contributions, but you can only go back as far as 6 years. The current full new state pension is £185.15 per week as at January 2023, but it's likely to rise to £203 in April due to September's 10.1% inflation. Future increases are inevitable with the triple lock, which guarantees state pensions increase by the greater of the increase in national average earnings, the increase in consumer prices index, or 2.5%. Now, checking your state pension forecast is important for retirement planning. Not only does it enable you to see what we'll likely receive at state pension age, although this is likely to rise with inflation, but it also allows you to see your national insurance contribution history. It's super easy to do. You just need to go to www.gov.co.uk/check state pension, link in the description, and create a government gateway account if you don't already have one. You can then find out whether you are A, already eligible for the full state pension, B, how long you have remaining until your state pension age, and C, whether you have any gaps in your national insurance records. So a pension is one of the places you can save for retirement by building up a lump of money before you start taking money back out again to fund your retirement. Tax-free cash was renamed PCLS when the pension rules changed in April 2006. Currently, the PCLS is tax-free. It can be up to 25% of the value of the fund or the remaining lifetime allowance, whichever is smaller. Taking benefits from a pension is called crystallisation event. You can crystallise all your pensions in one go or crystallise your pensions in stages to suit your circumstances. This is sometimes called phased retirement. For example, you might need access to £10,000 of tax-free cash to purchase a new car, but don't require any income because you're still employed. In this case, you could crystallise £40,000 of your pension fund to pay out 25% tax-free cash, i.e. £10,000. Each time you crystallise some pension benefits, you can choose any one of these three options. Lifetime annuity. You'll be able to use some or all of your funds to buy an annuity, which is a guaranteed income for life. When you buy an annuity, you can take a tax-free lump sum of up to 25% of your pension pot if your pension was previously uncrystallised. You can elect to include a spouse's benefit. If you don't, you cannot add it later. Flexi Access Drawdown, you'll be able to put funds into drawdown. There is currently no limit on how much or how little you can take from your drawdown funds each year. When you put funds into drawdown, you can take a tax-free lump sum of up to 25% of your pension pot at the same time. Taking an income withdrawal, not tax-free cash, will trigger the money purchase annual allowance. You can take a lump sum payment. Some pension providers now offer the option to take money direct from your pension pot without having to buy an annuity or put the money into drawdown. And 25% of this sum will be tax-free because it's made up of tax-free cash. The remainder is a taxable income withdrawal. This is called uncrystallised funds pension lump sum, UFPLUS. You'll usually pay a lifetime allowance tax charge if the cumulative value of your pension pot you have crystallised are worth more than the lifetime allowance. This is currently £1,073,100, fixed to 2026. You might be able to protect your pension pot from reductions to the lifetime allowance. What counts towards your annual allowance depends on the type of pension pot you get. Both defined contribution and defined benefits pensions count towards lifetime allowance. All payments from an annuity or flexi access drawdown and 75% of the amount of any uncrystallised funds pension lump sum are taxable as income. The amount of tax you pay will depend on the amount of payments that you receive in the tax year plus any other taxable income you have. You'll get a statement from your pension provider telling you how much tax you owe if you go above your lifetime allowance. Your pension provider will deduct the tax before you start getting your pension. The rate of tax you pay on pension savings above your lifetime allowance depends on how the money is paid to you. The rate is 55% if you take it as a lump sum, 25% if you take it any other way, i.e. as future withdrawals. The lifetime allowance has now been frozen until at least 2026, which means more and more people will have pension funds in excess of the lifetime allowance. Taking income from a flexible pension, not pension commencement lump sum, will trigger the money purchase annual allowance. This reduces the annual allowance from up to £40,000 down to £4,000. The money purchase annual allowance won't be triggered if you buy an annuity or uncrystallised funds pension lump sum, or if you cash in a number of small pension pots valued under £10,000 each. The money purchase annual allowance only applies to money purchase defined contribution arrangements. If your annuity is outside its guaranteed period and/or you did not purchase spouse's benefit or your spouse has already passed away, then your annuity dies with you. If you purchased a spouse's benefit, typically 50%, it'll continue to be paid for the rest of their lifetime. Crystallised and uncrystallised pensions are treated in exactly the same way for tax purposes. The key point here is that if you die before the age of 75, then all pension benefits are passed to your nominated beneficiaries free of income tax and usually outside your estate for inheritance tax. If you die after the age of 75, then all pension benefits are passed to your nominated beneficiaries and are not usually included in your estate for inheritance tax. But the beneficiaries will pay income tax at their marginal rate in the tax year they make a withdrawal from the inherited pension fund. The pension benefits must be accessed within 2 years of death. Alongside any personal pensions you may have, you will also have your state pension. In order to get the full state pension, you will need to have 35 qualifying years of national insurance contributions. Otherwise, you'll receive a reduced state pension. Checking your state pension forecast is important for retirement planning. Not only does it enable you to see what you will likely receive at state pension age, although this is likely to rise with inflation, but it also allows you to see your national insurance contribution history. It's super easy to do. You just need to go to www.gov.co.uk, check state pension, link in the description, and create a government gateway account if you haven't already got one. You can then find out whether you are already eligible for the full state pension, how long you have remaining, and whether you have any gaps in your national insurance records. You can also see where you are entitled to any additional state pensions. If you enjoyed that video, it would be great to have you subscribe to our channel, hit that notification bell, and don't forget to press that like button so you don't miss out on our next video. Now, if you like this video on pensions, I'm sure you're going to love this one on the differences between Flexi Access Drawdown and Uncrystallised Funds Pension Lump Sum. And here's a link to our 444 playlist. Take care, and I'll see you in the next video.